Hello and welcome to the revision session. Good evening, everyone. All right, just waiting for everyone to join. Good evening, Chaitanya. Thank you so much. Uh, Ov- Ovia, very different name. It's lovely. Thank you so much. All right, guys. So today we are going to discuss one very interesting topic. We will start with private placement. I hope my voice is loud enough. Yes. Good evening, Archana. Good evening. So, guys, today we are going to discuss one very important topic, that is private placement. Okay? We are going to discuss private placement, and then we will also discuss. My pleasure, Archana. I'm so happy that you all are able to understand and revise everything. Thank you so much for your appreciation. All right, guys. So let us continue our discussion. Yes, today we have lots to cover. In my earlier session, I had not discussed private placement section 42. I have already prepared a small note for you. So you can come back and you can write this in your notebook. No need to write anything right now. So I have prepared a note and you need to study just this note for exam. It will cover mostly the entire concept. Now you are all aware that private placement is a method of issuing shares or securities. So in case the company feels that it need not go to the general public, they will be able to raise money from a selected group of persons. Then they may go for private placement. But there is a procedure to be followed. There are provisions of section 42 applicable. So these are the few pointers that I have selected that will help. It covers everything in short. So what is the meaning of private placement? It is nothing but offer of securities made to a selected group of persons, and the offer is made through the issue of offer letter. Now this group is selected by the board of directors. So they will prepare a list and they will place it in the board meeting that these are the shareholders, these are the persons to which we are planning to issue the offer letter, and the offer will be made to a selected group of persons. It is very similar to a specific offer. This offer of private placement can be accepted only by the person to whom it is made. In a year, you can make an offer to maximum 200 persons. It cannot be made to more than 200 persons. Ma'am, is it possible that I make the offer to 1000 because we don't know how many will accept this offer? No, you cannot make an offer to 1000 people. The offer can be made only to 200. Then all 200 may accept, or just 150 may accept, or just 100 may accept. So if I am making an offer to 200 persons, then it is private placement. Offer made to more than 200 persons will be considered as public offer. Okay, so it will be considered as a public offer. Offer made to maximum 200 persons in a year. So in a year, financial year, I cannot make the offer to more than 200 persons. It cannot be like I made an offer to 200, only 100 purchase. Now I made an offer to another 200. No, the offer can be made only to 200 in a year. It is possible that not all of them purchase the shares, only 100 subscribe. That year's limit is over because the offer was made to 200%. So 200 persons in a financial year, this will exclude QIBs and employees to whom the securities are offered in ESOP. Now these persons will general meeting. So I have also highlighted the words we will pass a special resolution in the general meeting. Now you are calling a meeting, so you need to give a notice. Now, if I simply write that we are going to offer securities, people will have so many questions regarding that. So you also need to submit an explanatory statement to that notice. That explanatory statement will have to mention the particulars and the amount of offer, the date of passing the board resolution wherein the board proposed that we should offer the securities to this list of persons, the kind and price of securities offered, the name and address of the valuer who has valued the securities. So the valuer will decide that this is the price at which you can offer the security. So we want the name and address of the value and how he has made the valuation and any other material item. So this will give the investors, the shareholders, a clear idea as to how the company is planning to raise the money through private placement. The private placement offer does not carry the right of renunciation. Renunciation means to renounce the shares, to give up the shares in favor of the other person. Now, that is possible in case of rights issue. But if the offer in private placement is made to a particular person, he cannot say, I'm not interested in buying this. I will now ask somebody else to accept this offer. I'm renouncing the offer in favor of the other person. No, the offer was made to a specific person. It can be accepted by that person only. If he doesn't want to accept it, he will have to reject it. He cannot say, my friend is interested, I will ask him to subscribe. Offer was not made to him. The identified persons who are willing to subscribe, they will fill and submit the application form to the company along with the subscription amount. Now, this subscription amount will be made in the form of check, demand draft, and other banking channel. It will not be in the form of cash. This is just to avoid money laundering. So, if you want to subscribe for the securities, then you need to make the payment. You need to make the application by giving the payment either by check, demand draft, or any other banking channel, but not by cash. So ASBA facility is available where the amount is blocked, and if you are allotted the shares, that amount will be deducted. The company will keep a record of the bank account of the subscriber. Now, why are we keeping a record of the bank account? See, because, hi Harsh, good evening. Why are we keeping a record of the bank account of the subscribers? See, in case you are not allotted the shares, okay, in case you are not allotted the shares, the refund will be made in that account only. XY, they are joint holders. In case of joint holders, money will be deducted from the amount from the account of the person whose name appears first in the application. There are many persons who made an application to the company. The application money will be kept in a separate bank account and it will be utilized only for the purpose for which it was raised. The allotment by the company, see how I have written the note. People make an application to the company. This is simplifying the concept. So people will make an application to the company. These people, these persons are those to whom the offer is made. So the persons to whom the offer was made will make an application to the company. The application money which they give along with the application will be kept in a separate bank account. The company will make the allotment within 60 days from the receipt of the application money. In case the company fails to make the allotment within 60 days, they will repay the application money within the next 15 days from the expiry of 60th day. Okay, so as soon as 60 days expire, within the next 15 days, they have to refund the amount. If they fail to refund the amount, then the company will have to refund the amount along with interest at the rate of 12% per annum, and this interest will be calculated from the 61st day till the date of payment. Okay, the company cannot advertise this to the public. It's a private placement. You cannot advertise it. General public cannot subscribe to it. So no public advertisement. The company will also file a return of allotment within 15 days from the allotment. Default will attract penalty. So students, these pointers will help you to recall the entire concept, and you can revisit the video. You can come back again and you can make a note of the note. I would really insist that you write this in your notebook because it will help you to revise the concept very quickly. If you want, you can make additions. Like if you want, you can write what is the amount of default. If you feel that, ma'am, we want to write some more, you can make addition, but at least you will get an outline of the entire concept. Yes. So with that, we finish our chapter on prospectus and allotment, including private placement. Now let us discuss today share capital. Okay, I'm only going to cover the concept of share capital. Debentures we will cover in the next lecture, and also transfer and transmission. Yes. OVR, yes. Now, 50 limit is what purpose? All right. See, earlier they had a limit of 50, but they had also mentioned, please go through the wordings of the provision. They had said that 50, maximum 50, or a higher limit as maybe prescribed. Okay, as prescribed. In the act, it is still 50. But what is prescribed as per the rules? 200. So you can make an offer to maximum 200 in a financial year. In the study material also, you will find 50 or a higher limit as may be prescribed is written in the answer, because that is how it is written in the main section. But what they have prescribed is 200. So for the question answers, you will consider as the limit 200. Okay. This is just like in small company, the limits are still mentioned as the earlier one, but as prescribed, that prescribed word shows that the limits have been increased to 4 crore, 40 crore. Same logic applies here also. Okay. Let us discuss the concept of share capital and debentures. Now, before I discuss the concepts with you, I would like to inform you about the Before I discuss the concepts with you, I would also like to inform you the topics which are important for exam, and the topics on which the questions are generally asked, be it theory question or case based. Now, in my chart book, you will find only the important concepts for exam are covered. This chapter is actually very vast, but I have covered only those topics which are very, very important for exam, and 100% question is asked. Okay. Now, questions are asked on DVR. They will ask you a theory question. Okay. On DVR, they will ask you a theory question. Further issue of capital, that is section 62, again, they will ask you a theory question, but case based question. Okay, Ritik, it's a very unique comment जो आपने लिखा है. It's a very unique one. But I really liked that, law lecture helped you to forget about your exam tomorrow. Uh, I would just like to say one thing to you, that it is very normal to feel tensed, but everything is over here. Today, I was listening to a podcast, and it said that nowadays, because of the social media and other pressures, it is very normal for people to feel anxious or to feel tensed. But just keep reminding yourself, okay, just tell this to yourself 2 or 3 times and you will feel relaxed. Just tell yourself that I have done my best and I will leave the rest to him. Everything is pre-planned for you. Okay? Everything is pre-planned. So getting tensed and worrying about your exam is not going to help you. What you need to do is keep all that aside and focus on your study. Like it happens with me also. I'll give you my example. Okay. Sometimes, when we have to prepare for any particular session, or anything wherein I need to give a maybe 15-20 minutes, I need to talk about it. Sometimes I'm not prepared, because we also have to plan, no? Like if I want to take the live session, I also have a flow that I generally plan, that this is what I will cover, this is the flow in which, this is the extra note which I want to share with my students. Sometimes even I'm not ready, I had just half an hour today and I had to plan the entire session that I'm going to take today. I was also very tensed in the same situation. I was also very tensed, but I just reminded myself that I can do it. Half an hour is sufficient for me, I can do it. I just kept on telling this to myself 10 to 12 times. I can do it. Half an hour is sufficient for me. I dropped my son to his table tennis class and I came back. I had just 25 minutes to plan the entire lecture, that this is all what I will cover today. And I have made notes also for you. Okay, these are the things which I want to give to my students. But because I was so focused, I kept reminding myself, I can do it. I can do it. Half an hour is sufficient for me. It is more than enough for me. I can do it. I can do it. And before your lecture started in half an hour, I was also ready with the notes. Okay, this I wanted to tell you, and I was ready with it. Why I wrote all this? I could have written this during the lecture also, but I didn't want to waste your time. Okay, so yes, I can make a video regarding the important sections. I can do that, but I'm telling you the sections in these revision lectures only. So if you attend this, I think you will be able to know. Okay, so just keep telling yourself, I can do it, I can do it, I can do it. I know this is best for me. I will give my best, and I will just leave it. I will leave the rest. See if it works for you. It actually worked for me today. I hope it works for you. So, guys, I was telling that further issue of capital can be asked as a theory question. There is a small exception, which is this. Where is it? Yeah, this. This is an exception to section 62. Okay, section 62, subsection 3. This is very important for case based question. That is why I have written this specially for you. Case based question. Okay. So, conversion of debentures or loan into equity, that will not result in the further issue of capital, and section 62 will not apply. This is important for case based questions. Then we have bonus shares. Yes, it is important for case based question, but you will have to write the entire theory. Only the framing is like a case based question. Irredeemable preference shares, section 55, very important for exam, can be asked as a short note. This is also very important for exam. This can be asked as a case based question. Can be asked as a case based question. Then use of securities premium, very important for exam. Generally asked as a theory question. Maybe 4 to 5 marks of weightage. Buyback, very important. Now, please learn the theory. The framing is like a case based question, but they expect you to write the entire theory. Okay, so this theory is very important. The procedure which I have given, this you need to learn. Okay. If a case based question is asked, it will be mostly on this one. Okay. And also this is very important. What are the sources of buyback? Sources of buyback, very important. Sweat equity, yes, can be asked as a theory question. The limits are important. Please learn the limits. Okay, limits are important. ESOP, again, the procedure is important, the theory is important. Issue of shares at discount can be asked as a short note for 4 marks. Reduction in capital asked as a theory question. The procedure is important. You need to learn this. Okay, learn the procedure. So this is very important for us. This I have prepared a list of section 62 along with subsections and clauses for your understanding. Let us discuss. All right. Now, there are different kinds of shares. So you have equity share capital and preference share capital. Equity share capital may be with voting rights, like one share, one vote. These are known as plain vanilla shares. Or it may be equity shares with differential voting rights, DVRs. It may be as to dividend, voting, etc. Normally, what happens is one share, one vote. But in case of DVRs, that is differential voting rights, maybe 10 shares will give you one vote. These are known as shares with inferior rights, because 10 shares will give you one vote. There are superior kind of DVRs also, wherein it is possible that one share will give you 10 votes. But in India, this is not allowed. Okay, this is not allowed. One share is 10 votes. So we will discuss 10 shares will give you one vote. They are DVRs. That is shares with differential voting rights. Now, plain vanilla shares, one share, one vote. DVRs will offer just one vote if you have 10 shares. Now, why will someone want to purchase shares with differential voting rights? See, I'm not interested in voting. I don't have time also to go and vote. If I am sacrificing my vote, then I need something more. So these shares get more dividend. Okay, if I am sacrificing my vote, then what will I get in return? Then I get dividend. So these shares attract more dividend. Okay, so in this case, so these shares attract, they give you more dividend. That is why people who are not interested in voting, but they're interested in getting regular income, for them, this is a very good option. Okay, so they generally go for differential voting rights. So what is the procedure? Now, what I have done is in my chart book, I have simplified the entire answer for you. So just learn this. In order to issue DVRs, you need authorization in the articles. Now, students, if this question is asked in the exam, they may expect you to write the rule also. So please note that these provisions are covered in Rule 4. Now, which rule is applicable to this chapter? The rule which is applicable to this chapter is companies, shares and debenture rules 2014. Okay, so this is the rule which is applicable in that Rule 4. Okay, so Rule 4 of companies, shares and debenture rules 2000, share capital and debenture rules, share capital and debenture rules 2014. Okay, so Rule 4 says that in order to issue DVRs, you need authorization in the articles. Just pass an ordinary resolution. Just pass an ordinary resolution in the general meeting. The voting power for DVRs should be less than or equal to 74% of the total voting power. Now, what is the meaning of total voting power? Let's say, for example, that I have normal equity shares, one share, one vote. Okay, I have 10 shares at 10 rupees each, so my investment is 100 rupees. Now, these shares, one share will give me one vote. I have 10 shares, so I will get 10 votes. Okay, so these are normal shares, one share, one vote. I have purchased 10 shares of 10 rupees each. So these 10 shares will give me 10 votes. The company has also issued DVRs. So DVR, 10 shares will give you one vote. Okay, this DVR is 10 shares will give you one vote. Yes, Kunal, we will also, all right. We are also coming up with the revision session for foundation. So please check the YouTube community post. for the announcement. We will very soon be coming up with detailed revision lectures for CA Foundation. Okay. So what was I saying? Yeah, we have equity shares. These are normal ones. These are DVRs. 10 share will give me 1 vote. Now I have 10 shares and that will give me only 1 vote. So the total voting power of the company will be 10 votes for the normal one plus 1 vote for DVR. So the total voting power is 11. Now out of these 11 voting, out of this 11 voting power, 1 vote is for DVR. So DVR's voting power is 1 upon 11. How did I get 1 upon 11? It is, see this, 1 upon 11. So that comes to 9%. And the limit is 74%. So this is how you will calculate the total voting power. This is the voting power for the normal shares. This is the voting power for equity. Yes. So the total voting power is 11. 1 out of 11 is the voting power with DVR, which comes to 9%, and that is less than 74%. The issue of DVR is within limits. Okay, so this is how you will calculate total voting power. So you need authorization in the articles. OR in GM, voting power should be less than or equal to 74% of the total voting power. The company should not have defaulted in filing the financial statements under Section 137, annual return under Section 92 for the last 3 financial years. The payment of dividend, deposits, redemption, there should not be any default. The company should not have defaulted in the repayment of the term loan along with interest. Now you are saying that you don't have money to pay all this and you want to issue DVRs and give them more dividend. See, if they're sacrificing their voting, you will give them more dividend. Now you're saying that I don't have money to repay deposits, redemption proceeds of the preference shareholders, debentures. You don't have money to pay the term loan and interest, and you want to pay money to the DVRs. You want to pay them more dividend. First, complete your existing obligation. Then we will allow you to issue DVRs. The company should not have any penalty imposed on it in the last 3 years. This penalty may be imposed under the, maybe by any penalty under the RBI Act, under the SEBI Act or FEMA. Okay. So there should not be any penalty under any of these acts. The disclosure in the board report. So board report will disclose the amount of DVRs issued at, and what is the voting power that you have given to DVR. The details of the DVR will also be mentioned in the register of members. So in the register of members, we will also mention that these are the shareholders to whom DVRs are issued, and this is the ratio in which they will exercise their voting power. So that was all about DVRs. Now coming to preference share capital, they carry preferential right. They will have the right to dividend before it is given to the equity shareholders. They will have the right to repayment of capital at the time of winding up before it is given to the equity shareholder. So they have preference over equity. This is, you can study. I don't think this will be asked in the exam, but we have irredeemable preference shares, which is very important for case based questions. Okay, so this is very important, can be asked as a short note. It can also be framed as a case based question, but you need to learn the theory and also learn this part is important. Now we cannot issue preference shares which are irredeemable. Irredeemable means they will not be redeemed for a very long period of time. Maybe they will be redeemed at the time of winding up of the company. So these shares which are not redeemed, they are known as irredeemable preference shares. The company is not allowed to issue preference shares which are redeemable beyond a period of 20 years. So that is the maximum that we can issue. So they are not redeemable during the lifetime. As per section 55, it is very important for you to learn the section number. The section number is important. No company limited by shares will issue preference shares which is irredeemable or redeemable after a period of 20 years from the date of the issue. The only exception that they have made is in case of infrastructure project. So companies engaged in infrastructure projects, we know that it takes a lot of time for them to generate revenue. Only once they generate the income, they will be in a position to redeem the preference shares. You can also add over here that we need the authorization of articles. You can add that point over here. If there is no authorization in the articles, you first amend the articles, bring the authorization, only then you can issue preference shares which are redeemable. Okay. So company will issue preference shares, but they have to be redeemed within 20 years. Only in case of companies engaged in infrastructure projects, it can be redeemed beyond 20 years, but not 30 years. Provided that every year at least 10% will be redeemed up to the 30th year. So from the 21st year onwards, okay, from the 21st year onwards, I will redeem at least 10% every year. Okay, so it means that by the time I reach the 30th year, everything will be redeemed. Good evening, Pranav. Good evening. Now, redemption will be made out of the profits available for dividend, that is free reserves, or proceeds from the fresh issue of shares. Now, this fresh issue may be either equity or preference. So, you may issue fresh equity and use those proceeds to redeem the preference shares. In case of redemption, a sum equal to the nominal amount of the shares will be transferred to CRR. CRR is nothing but the capital redemption reserve. So the amount which is equal to the nominal value. Now this will happen only when you are utilizing the profits of the company for redemption. What if the redemption is out of the proceeds of the fresh issue of shares? Then CRR is not required. CRR is required only when you are redeeming the preference shares out of the profits available for dividend. So this profit was actually available for the creditors, for the shareholders. You're using that profit for redemption. Then you need to create CRR. CRR is basically for giving assurance to the creditor that yes, we are redeeming the preference shares. The capital is going out of the company. The money which we had to use for you, that is depleting. Don't worry, we have created CRR. That money will be used only for the creditor. So it is just an assurance given to the creditors. The premium on redemption will be provided out of, yes, please highlight this. This is also very important for exam. The premium shall be provided for out of the profits or securities premium account before the shares are redeemed. So you will have to make a provision out of the profits or securities premium for the premium to be paid on the preference shares. Now, it is possible that the company doesn't have money to pay the preference shareholders. So what they are saying that we will issue new preference shares and we will assume that the preference shares are redeemed. So they are just, replacing it. So I don't have money to pay. I'm giving you more preferences. Now 20 years are over. I need to redeem. I don't have money. So you accept new preference shares and we will assume that the old preference shares are redeemed. So it is like, we gave you money and you gave that money back to us in return of new preference shares. Now, if the company feels that they are not able to redeem the preference shares, they are not able to pay the dividend, they shall, with the consent of the 3/4 of the value of preference shares and the approval of tribunal, they may issue further redeemable preference shares equal to the amount of unredeemed preference shares plus dividend. I am not in a position to redeem. I don't have money. So it is as if I have given you the money and you have returned that money to me and I have issued fresh, further redeemable preference shares. But this is possible only with the consent of the members holding 3/4 of the value of preference shares. So if the unpaid is 10 lakhs, 3/4 means people holding at least 7.5 lakhs have given their approval that yeah, we are okay with this exchange scheme. So then in that case, the unredeemed preference shares shall be presumed to be redeemed, but not all may consent to this. So people who do not consent, those preference shares will be redeemed. Okay, so the non-consenting shareholders will be redeemed. Please learn this for exam. It can be asked as a case-based question. Okay. Then we have the use of securities premium account. Yes, we can issue preference shares and even equity shares at a premium. The premium will be recorded separately. It's a capital reserve. It has specific uses. Please note, students, that the section number is very important for exam. It is very important for you to learn section 52. You also need to learn how the securities premium can be utilized. This is a pure theory question. You have to learn it. There is no logic. It is something which can be asked maybe as a short note. Yeah. So to issue fully paid up bonus shares, this is actually just a book entry. Actually, there is no money flow over here. So this is just a book entry. Okay, it is. So you will debit the share premium account or the securities premium account, and you will credit the equity share capital account for the bonus that is issued. This is actually just a book entry. To write off the preliminary expenses, to write off the public issue expenses like underwriting commission, advertisement. This is also again just a book entry you can write. So this is also just a book entry. No money comes in or goes out from the company actually. Discount allowed on issue of shares. Ma'am, we thought that shares cannot be issued at a discount. They can be issued at a discount only under certain circumstances. We are going to discuss that in section 53. Premium payable on redemption of redeemable preference shares or debentures, and it is also used for buyback. It is one of the sources of buyback. Okay, so it is one of the sources of buyback. The word provide here means that you need to create a provision. Okay, we will create a provision from the securities premium account for the payment of premium payable to the at the time of redemption of redeemable preference shares or debentures. Then we have bonus shares. Yes, bonus shares means shares which are given free of cost. Yes, we don't get any money for that. They are given free of cost. So bonus shares, they are shares which are given without any consideration, but they are given only to the existing shareholders. Of course, you will not give free shares to outsiders. You will give them to the existing shareholders. So what are the key words over here? They are issued without any consideration, and they are also issued to the existing shareholders. You need to write this in your answer. Why? It is nothing but a capitalization of profits or reserve. See, I don't have any other use of that reserve which is there with me. So it is just like this year I will not give dividend. Instead, I will give you one share for free. So that share which you receive for free, next day you can go and sell it in the market, and whatever money you receive, that you can consider as your dividend. Okay. But if the shareholder say, no, 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 we don't want share, we want dividend only, then the company cannot say, now we don't have cash, you accept dividend. You accept bonus shares. Bonus shares cannot be given in lieu of, means instead of dividend. If the shareholders want dividend, we will have to give them dividend only. If they're okay with bonus shares, then we will give them bonus shares. What is the procedure? I need authorization in the articles. You need a board's resolution, which will recommend the issue of bonus shares. Then we need an ordinary resolution. Just an ordinary resolution in the general meeting is to be passed. Who will not give their consent to free shares? Yeah. We must implement the bonus issue within 2 months of the approval in the general meeting. The existing shares as well as the bonus shares must be fully paid up. The existing shares must be fully paid up, and the bonus shares must also be fully paid up. These are free shares. You cannot expect people to give you something in return. So these are fully paid up shares. They cannot be used in lieu, they cannot be issued in lieu of dividend. But ma'am, you just said that this year I didn't have dividend, so I suggested that you take bonus shares. Yeah, but then that resolution was passed by the board. Members also agreed, na? That instead of dividend, you give us bonus shares. But what if the members want dividend only? Then you cannot tell them, Arey, you accept bonus shares now, we don't have money. Bonus cannot be issued in lieu of dividend. If they want dividend, you will have to give them dividend. This is very important for case based question. The company should not have defaulted in the payment of interest, principal of the deposits, debentures, statutory dues of employees. You don't have money to pay all this, and you want to issue bonus shares. First, fulfill your existing liabilities. So this can be asked as a case-based question. The company has not paid PF or bonus, and they want to issue bonus shares. Is it possible? Okay, that way it may be asked in the exam. Then we have the further issue of shares, which is also known as rights issue. Students, is a very lengthy section, section 62. So see, I have prepared a small note for you. You can come back and view this note again. Okay. You may not write anything right now. Section 62, subsection 1, clause A says that further issue must be to the existing shareholders. Existing shareholders have a preemptive right. Preemptive means they have priority. It is mentioned in the act that the equity shares, whenever the company is planning to go for further issue, they have to offer the securities to the existing shareholders first. Okay, so you have to offer the securities to the existing shareholders first. That is the normal routine, I should say. That is the normal procedure. You have to offer the shares to the existing shareholders. But we don't want to do that. Like again and again, we don't want to first offer to equity, existing shareholders, then we go for ESOP. So law says let's do an idea. If you want to issue further shares to employees under ESOP, law says don't forget the sequence. First offer the shares to the existing shareholders, then to employees. But why? These are ESOPs. They have no connection with the existing shareholders. So do one thing. Ask their approval. Okay, tell the existing shareholders, is it okay if we don't offer shares to you and directly go to the employees for ESOP? If they have given their approval through the special resolution, then you need not offer shares to the existing shareholders. You can directly offer shares to employees under the ESOP, that is employee stock option scheme. We can directly go to other persons if SR is passed. SR is passed means the existing shareholders are giving their approval, or it is okay. It is okay. Don't offer shares to us. Anyways, we are not interested in buying more shares. You can give it to the general public. But law says first you offer it to the existing shareholders, then to any other person, including public. But if they are okay, they pass SR, then you can directly offer shares to the public. Section 62, subsection 2 talks about dispatch of notice to the existing shareholders. At least 3 days notice should be given before the issue that we are planning to come up with further issue of capital. This is very important for exam. Convertible debentures or loan. So if the debenture or loan is converted into equity, that will not attract section 62. The procedure for further issue is not required, provided you obtain the consent of the shareholders before you issue the convertible debentures or loan. So please note that if a question is asked in the exam, it will be on this. So section 62 does not apply. It means the procedure for further issue will not apply if the increase in the capital is due to conversion of debenture or equity or loan into equity. The option was approved before. This is the key word. Before the issue of such debentures or loan by a special resolution. So if we have obtained the approval of the shareholders through a special resolution, even before we issued the convertible debentures or equity, then law says when they are converted, it will not amount to increase of capital and the section 62 will not apply. This before word is very important. Ma'am, do we also need the approval when they are being converted? No, that time we don't require approval. Approval of the shareholders is required when you issue the convertible debentures or loan. So conversion, this is not important for you, terms and conditions. If you have my textbook and you are my student who has opted for the full course, then of course this we have covered in the lecture. Now revision, it is not required. When the shares are offered to existing shareholders, it is known as rights issue. They have a preemptive right, priority. Why? Because we need more funds. Okay, now they may be offered to the existing shareholders. You need to give them a letter of offer. See, if you want to buy, we are giving you priority. Because the existing shareholders will argue with the company. Arey, you before going to the outsiders, you should have asked us. We would have only bought it. The rights offer is to be made by notice. The notice will mention the number of shares offered, the time for acceptance, minimum 15 days or less, that can be 7 days. Okay, this is mentioned in rule 12A. Again, which 12A of what? Share capital and debenture rules 2014. So 7 days mentioned by rule 12A. They should also mention that what if you decline? How will we, then what will we do with these shares? So if the existing shareholders don't buy, then what will the board of directors do? How will they offer it to the public? You will also mention that right of renunciation is available. Renunciation means you can renounce it in favor of any other person. That person may be a member or a non-member. Renunciation. I am not interested. My friend is interested. So I can renounce the share in his. I can renounce the right in his favor, and he will apply for the share. Okay. We will also. Sorry. Decline. It will also say that if you have not accepted the offer within this period, we will assume that you have declined, and the power of the board to dispose the. So if they don't subscribe, then the board can dispose of the share in a manner that they think fit. How it is to be done, we leave it up to the board of directors. ESOP and any other person. So please write this later. This is important. It will provide you a list. This is also very important for case based questions. Issue of shares at discount, section 53. Students, if you feel that, we have studied so much, we are tired, it's just one page which is remaining. Let's quickly cover this page and then we will be done with the part of share capital. I think we can push ourselves. Yes, we can do that. Issue of shares at discount. Can we issue shares at discount? No. Short note can be asked. Any share issued at discount is void. Okay, it is void. Now, why? What is the reason? Like, what is the logic? Earlier it was allowed. Now you're suddenly saying that you cannot issue um, shares at a discount. Now, let's say, for example, that you have purchased my chart book by paying 500 rupees. Now, there is another friend of yours to whom I gave this chart book for 300 rupees. So you will definitely be angry, no, ma'am, I purchased for 500 and you are giving it to my friend for 300. This is not fair. So law doesn't want to differentiate between shareholders. So like I gave the share to one person at face value and other I gave at discount 8 rupees. So I don't want to differentiate. That is why you can no longer issue shares at discount. That is why it is void, because we don't want to differentiate between shareholders. That's the only logic. So when the shares are issued at less than the face value, it means the shares are issued at a discount. The company may, however, now these are exceptions. This is very important for exam. The company may issue the shares at discount to its creditors when a debt is converted into shares in pursuance of any statutory resolution plan or debt restructuring scheme in accordance with the guidelines or directions of SEBI. So we are not able to pay money to the creditors. So we tell them that I will issue shares. He said, why should I buy shares from you? Face value is 10. What benefit will I get? No, sir, we will give it to you at discount. Please, we don't have money. You accept the shares of our company. So if there is a debt restructuring scheme, then yes, you can issue shares at discount. If you issue shares at discount, then other than this exception, then you will be punishable for a penalty, that is the amount raised through the issue of discount, or 5 lakhs, whichever is less. So the amount raised was 3 lakhs, 5 lakhs, whichever is less. So I will be subject to the penalty of 3 lakhs. The company will also have to, so this is penalty, but the company will also have to refund the money along with interest at the rate of 12% per annum. This is something which you just need to memorize. There's no logic. Then we were also discussing ESOP. Yes, I would like to cover ESOPs. That is Employee Stock Option Scheme. This is like a carrot to the employees so that they don't leave the organization. Employee stock option, it's basically a reward to the employees for their um, loyalty, and it's a part of their salary package. Okay, so if they are in the company for 3 to 5 years and they have contributed in increasing the profit of the company, so this is like a reward which we have given. So employees have an option to purchase the shares at a predetermined price. Now, if the price at which they can purchase the share is, let's say, 250, the market price, the market price is 300 rupees. Wow. I get to buy the shares at 250. I can go and sell it in the market for 300, thus earning a cool profit of 50 rupees. This is known as in the money. In the money means it is beneficial for me to exercise the price. This is known as exercise price. Exercise price means the price at which I can purchase the share. But what if the market price is 200? Array. When the market price is 200, who will buy it for 250? Na? So in this case, law says that it is better to go and buy it from the market. This is out of money. I will not exercise the option. Anyways, it's an option, it's not a compulsion. So I will not exercise the option. I might as well go and buy it from the market for 200 rupees. So this is an option which is given to the directors, officers, employees to purchase or subscribe for the shares at a predetermined price. Okay, I will buy it at a predetermined price. So you need to follow the SEBI guidelines if it is a listed company. But if it is an unlisted company, then we will follow the following. That is, you need the approval of the shareholders by a special resolution. Option is non-transferable. It cannot be delegated. That is pledged, hypothecated, or mortgage. Minimum 1 year gap between granting and vesting of option. Grant means it is given. Now, today I gave you the option. Tomorrow you can buy it at the predetermined price. It is not that way. I want you to stay in the organization. So today I have given you ESOP, but you can buy, you can exercise that option at a later date. That is known as vesting of option. So you can buy, let's say, after 2 years. So for 2 years at least you will stay in the company, increase the profit so that market price increase. You can buy it at a cheaper price from by exercising this option. Bonus, dividend, etc. cannot be availed on these shares until you exercise the option of purchasing. Yes. The company will maintain ESOP register in form SH6 and also provide disclosure in the directors. These are the main points. These are not the only points that you need to study. Yeah, if you see my textbook, you will find a detailed note on employee stock option, and in my lectures also I have discussed this in detail. Okay. We are almost coming to an end. Okay, we are almost coming to an end. Sweat equity. Sweat. I have worked very hard for the company. So this is also a kind of reward. Sweat equity is generally given either at a discount or for consideration other than cash. Okay. Now, we had studied that you cannot issue shares at discount, but there's an exception. You can issue shares at discount if it is a sweat equity. Yes, so we can issue shares at discount if they are sweat equity. So sweat equity shares are those shares which are given to directors or employees either at a discount or for consideration other than cash. What is the consideration? See, they may have given us technical know-how. They may have, added value. They may have given something which has increased the revenue, decreased the expenditure. Intellectual property rights, like they have given us patent, trademark. We don't have money to reward them. So we give them shares instead. Now, these are generally given to, okay, ESOPs can be given to, you can write it. Okay, it is given to employees. Of course, it is given to employees, but what kind of employees? Permanent employees. Okay, given to permanent employees. Okay, so if you are a permanent employee and you are showing you're working hard for the company, then only we will give you. It will also be given to whole-time employees and not part-time employees. Okay, it will be given to whole-time employee. Okay, So permanent employees, whole time employees. Here director is also given. So it can be given to independent directors. See, independent directors, they will get sweat equity. They are entitled. But they are not entitled to ESOP because they are not employees. They are independent directors. You can give it to promoter director. So he was a promoter and he's also the director of the company. And you can also give it to employees or directors of holding or subsidiary company. Okay, so employees or directors of either holding or subsidiary company, as the case. So these are the persons who are entitled to sweat equity. They are entitled to sweat equity. Now, we need to pass a special resolution. The validity is 12 months. What is the meaning of validity is 12 months? It means that you must allot the sweat equity. The allotment must be made within 12 months. So the allotment must be made within 12 months of special resolution. This resolution will specify the number of shares, what is the current market price, what is the consideration you have received, if any, and the class of directors or employees to whom you are offering these shares. You also need to follow SEBI guidelines. There are limits. You just need to learn these limits. Sweat equity should be less than 15% of the existing paid up share capital or shares of the issue value rupees 5 crores, whichever is higher. Very rarely we get to see this. So this is the limit in one particular year. Overall limit. Sweat equity should be less than 25% of the paid up equity share capital of the company at any time. So this you will find in Rule 8. This is given in Rule 8. So calculate 15% of the paid up share capital, compare it with 5 lakhs, whichever is higher. So it is not compulsory that you have to issue those many sweat equity shares. Now let's say 15% of the existing paid up capital comes to 2 crore rupees. Issue of and compare it with 5 lakhs, whichever is higher. So I can issue sweat equity up to maximum 5 crore rupees. It's not compulsory. I may issue for 1 crore, 50 lakhs. That's up to me. Maximum limit is 5 crores. Overall, it means up till now, if you have issued sweat equity, there should not be more than 25% of the paid up equity share capital of the company at any time. Word is equity. Huh? This you need to remember. Many a times we forget 25% of the capital. That is what we write. Equity capital. Because these are sweat equity shares. So we will check the equity capital here also. It is equity capital. So please pay attention to what is written. They will be locked in for 3 years. It means they are non-transferable for 3 years. Valuation will be done by a registered valuer. We need to provide disclosure in the board's report as to whom have you issued the sweat equity, how many shares that have you issued, what is the any special details for sweat equity. We will also maintain a register in form SH3. Next we have buyback of shares. Buyback, it means the company is buying its own shares, not for reissue. These shares will not be reissued. These shares will be extinguished. They will be destroyed. Why will a company buy back? Arey, I have a lot of money. I don't have any better use of that money. And the cost of capital is more than the cost of borrowing. I'm giving more dividend than the amount at which I will get loan. So if I need more money in the future, I will borrow it. So and there are so many other reasons for buyback. Sometimes the companies also buy back the shares just to increase the price. It is a good exit route for the shareholders. Like I had applied for the buyback of TCS. The market price was not increasing only. So it was around somewhere around 24 something, let's say 24.80. And they were ready to buy at 25.85, something like that. So I said, anyways, I'm not getting the return in the market. They are ready to buy it at a higher price. So I also gave my shares for buyback. It was a good exit route for me. So buyback will be at a price which is more than the current market price. So then that only then people will opt for buyback. No, otherwise they will sell it in the market only. So the company is buying back its own shares. Also, because you buy back, the number of shares reduces. So the dividend is now distributed among less number of shareholders. So it increases the EPS and the other ratios also. So it is buying back of the own shares. This is super important. Sources of buyback, very important for exam. Very important for exam. Sources of buyback. You can use free reserves. Free reserves are those reserves which are used for distribution in the form of dividend. You can use securities premium and proceeds of any other specified security. Please remember, students, if you are buying back equity, you cannot use the proceeds of equity. Okay, you cannot issue more equity shares and buy back equity. If you are buying back preference, you cannot use the proceeds of preference. But if you are buying back equity, can you use the proceeds of preference? Yes, that is possible. If you are buying back preference, can you use the proceeds of equity? Yes. If I am buying back 10% preference shares, can I use the proceeds of 8% preference shares? No, because they are the same kind of security. Okay. So if I'm buying back equity, I can use the proceeds of preference. If I'm buying back preference, I can use the proceeds of equity. The procedure is given, it is quite self-explanatory. You need authorization in the articles, pass a special resolution, but just a board resolution is required if the buyback is less than 10% of the total equity capital and free reserves. This is sometimes asked in the exam. Buyback should be completed within 12 months of passing the resolution. They have not written which resolution, because if board resolution is passed, then within 12 months of board resolution. But if a special resolution is passed because the buyback is more than 10%, then within 12 months of passing the special resolution. Buyback must not exceed 25% of the total paid up. Now here it is capital and free reserves. It's not equity, it is 12% of capital. In the overall year, it should not exceed 25% of the total paid up. Now here it is equity. So please pay attention to these finer points. The maximum debt equity ratio is 22:1, but that ratio is calculated after buyback. So after buyback, debt equity should not be more than 2:1. The gap between two buybacks should not be more than 365 days. This is also very important for exam. Okay, this is also very important for exam. There should be a gap of 365 days. Can be asked in MCQ also. Can be asked for MCQ. Can be asked as case-based question. They ask 2 or 3 sub questions. This is one of the sub questions. If you are using free reserves or securities premium, it means you are using the profit of the company. Then you also need to create a CRR equal to the nominal value of the shares. The buyback will be on proportionate basis from the existing shareholders. Generally, if it is from the existing shareholders, it is at a fixed price. But if it is from the market, okay, open market, then it is at varying prices. Okay, I just pick up from the market. So nobody will come to know whether my share has been bought back by the company or not. So it is from the existing shareholders, it is generally at a fixed price, but in case of open market, it is generally at varying prices. Now, what is the meaning of proportionate basis? Now, the company wants to buy back 100 equity shares, but the people have offered 150, okay, in total. So I go and ask individual shareholders, how much have you offered? Is it 10? Okay. So 10 into 100 out of 150. So this is how we will, this much only we can buy back. So proportionate means that I wanted to buy back 100, but people have offered more than what I wanted to buy back. So I cannot buy back all. Like when I had also offered my shares for buyback to TCS, I had offered, let's say for example, 50 shares. But there were so many people who had offered the shares that the company said, I can't buy so many. I have a limit. I want to buy back only this much. So our buyback was proportionate. I think 25 shares were bought back. 50% was bought back. So proportionately, the company will buy back. They will be physically extinguished within 7 days. No further issue of the same kind within 6 months of buyback unless it is an option exercise to convert the debentures, convertible debentures, etc. Register of buyback will be maintained. Listed companies will file a return of buyback. The company should not have defaulted. This is important for case-based question. First, you fulfill your current obligations and only then we will allow you to use that excess money for buyback. So first, use the money for paying off your existing liabilities, then we will allow buyback. So students, these were the provisions. There is one which is remaining over here, section 66, reduction of share capital. The procedure is very important for exam because this is generally asked as a theory question. What is the procedure for reduction? See, reduction of capital is actually not allowed because creditors are affected. When you reduce the capital, they are scared that the company will not have enough money to pay our liabilities. That is why reduction is allowed only with the approval of tribunal. What is the meaning of reduction? Like I have shares of face value 100. I reduce it, I face value 100 rupees 75 is paid up. Okay, it is paid up. So face value is 100, 75 is paid up. I tell them don't send 25 rupees. I don't want it. Now the shares are 75 rupees fully paid up. I am extinguishing the right. Face value is 100, paid up is 75. I am telling them don't send 25. I am extinguishing, reducing the liability of member. This is reduction of capital. Face value is 100. The paid up is also 100. I am returning 25. I don't need your money. Or I tell them I'm returning now. I will call whenever I require. In the first case, the face value is also reducing. Like I had received 75. I said don't pay 25. So here my not only paid up but the face value also reduced to 75. Here face value is not reducing. I am telling them you take back your 25 rupees. I will call it when I require. Ma'am, but what if I am returning 25? I will not call. Then yes, the share is reduced to face value 7. The difference is here people had not sent money and I am telling them don't send. Here they had sent money but I am returning it. Writing off or cancelling the paid up capital, here the capital is lost. Okay. So cancelling any paid up capital which is lost or it is not represented by any available assets. So there is goodwill, let's say of 2 lakhs. There are accumulated losses of 3 lakhs. Okay. So I tell the shareholders, you bear this. So they will say, all right, we will bear this loss. We will reduce our capital. We will use that money to write off the goodwill or accumulated losses. So the entry will be equity share capital 5 lakhs debit to goodwill 2 lakhs to accumulated losses 3 lakhs. So we have written this off and that hit is taken by the equity shareholder. So there is reduction of capital. 10 lakh capital is reduced to 5 lakhs now because the 5 lakhs which they reduced was used to pay off, was used to write off goodwill and accumulated loss. There is a procedure and you need to just learn it. It's purely theory. Mostly this chapter has procedures. So these are the steps which you need to follow and you just need to learn it. Okay. Students, with this we come to an end of the unit on share capital. In my next session, I will discuss transfer transmission of securities. And yes, transfer and transmission is important. Section 58 is very frequently asked in the exam. And I will also cover debenture. So in my lecture tomorrow, we will discuss transfer and transmission of securities and debenture. Debentures, this debenture redemption reserve, this table is very important. Okay, we will discuss that, and then we will discuss charge and deposits on Saturday. So by Saturday, half of your company's act will get over. All right, students, so I would like to take your leave. Please come back again and make a note of whatever I discussed today. There are many charts, there are many small notes which I made you write. So please write all that. It will help you to revise the concept. Okay. Let's end today's session, and I will see you tomorrow. Bye bye, guys. Good night.